Good Fed day, everybody. Hello, how are you? Alexander and Richard, Ingmar, all my trading warrior brothers and sisters, are you ready to react to the reaction? Hugo? Ryan, how are you? Okay, so yesterday was a very technical day after things were pretty wild, right? So Blake and I were talking about the S&P, and I brought up that there was a completed wave 3 down here. You know, it backed and filled yesterday and was a great scalp. In fact, one of our new members really, he had a nice testimonial that yesterday Blake's entry on this pullback paid for a year. And not just making money, but he was talking about what he's learning being in the members chat. So from here into the Fed, you know, I didn't draw the fibs, but 4,500 is big. And Grega also has some ideas about this that agreed that that was the end of 3 and we'd get a 4. I'll have to go back into the platform to see what he was talking about. So there wouldn't be an overlap. And if there was an overlap, it could actually be construed as bullish. So, you know, keep an open mind. There are certain areas it should not retrace above. My view, it's going to be a nice rally to sell. If it's a 4, we should get a pop. You don't know where it's going to end, and one more low, and then a better rally. What I'm really keying on right here is I'd like a resolution of the dollar already. So I'm hoping that Paul sounds real aggressive, okay, and that he's not worried about markets selling off. And you know, if someone asks him about it, he goes, "Well, you know, certain things were overvalued, and you know, it doesn't show any concern about it."
Suck it up.
Yeah, you know, the punch bowl is taken away till he flips the switch again. But for right now, there's no punch. So sell rips. I'd like to see the dollar complete. And Ryan, you know, I still think I think was pretty impressive with the risk off day that we had Monday.
Yeah.
When I couldn't see anything, I crashed Friday, the beginning of the crash, and yesterday. But I would have thought, like, say I wasn't looking at the market, or I did, you know, that the yen on a day like that would have been down here.
Yeah.
So
it did nothing. It did absolutely nothing.
Yeah, I mean, so and you know, yield softened that day, right?
Yeah.
So I think you have to respect it that there could be a challenge for a new high there, and most likely we're going to make new highs in yields and get the 2% thing over with.
Yeah, I think
it's not going to take much, right?
It likes to drag out of range, this dollar yen.
Yeah,
as we know. So yeah, and it's gonna. I think you're right. It's gonna have to take something, at least confirmation of the hawkish bias, which, you know, we've still got expectations that are running too far ahead of themselves anyway. But yeah, I think if the market wants to hear something, you know, oh, save the stock market, I don't think he's going to deliver that.
Yeah. So you know, interesting that how the yen held, and the 10-year really didn't give up much. And then you know, I look at this RSI reading here. I don't think that's a high because momentum confirmed it. So, you know, that's what I'm seeing. Oil is so resilient, you know, hardly gave up anything on the break. I mean, you know, he had a little pullback in oil, but, you know, keeps marching on.
Yeah, and still hanging in there, isn't it?
Once I want to ask everyone who's here, when's Putin going? What do you think?
Someone said,
if you don't think he's going to, you could say that too.
Someone pointed out, I saw it on Twitter or something, that he went, last time he went, it was just after the Winter Olympics. And obviously we've got the Winter Olympics in China, haven't we?
Right.
So it was like a week later or something. He went
like Feb 20th or so.
Something like that, yeah. So, yeah, after the Winter Olympics, if you want to date on it.
Well, you know, I'm not. This isn't political, but that guy Vindman, who was in Ukraine, who was a military guy and then got into the diplomatic corps, says that we're at a geopolitical inflection point that could determine how the world goes for years to come. It's not just another. It's not Crimea.
No.
So
anyway. It's good. It's good to see Germany are taking it seriously. Did you see the headline out a moment ago?
No.
UK is sending anti-tank missiles, and US is sending anti-tank missiles and equipment. Germany's sending 5,000 helmets.
So if you were Putin, would you wait for people to Vindman actually said he was lobbying the U.S. government to, do what they're doing now earlier for deterrence, but we're past that point. So if you were Putin, were you going to wait for, all the armaments to arrive? And I don't know what you guys think, but it might even be a bigger event than the Fed. It may be back-to-back Feds. I think
Europe's got to be
worried. Europe's got to be worried.
Really, I don't know. You don't
think so?
What are they doing there? As I just said, Germany's not sending any military out there. They're sending helmets.
Right.
And it's all for show. I think it's all for show. I hope it's all for show. We should all hope it's all for show. Why do you need 100,000 troops on the border with warfare the way it is these days? You just send a few drones over. You send your airplanes over, your bombers over. Russia can fly bombers
to occupy territory.
No, I get it, but to me, it looks like a big show. It's Putin saying, don't take your eyes off me. You want to threaten me, I can threaten you as well. You want to put sanctions on me, I can cut your gas off. Cut me from the SWIFT system. We'll cut your gas off. It's all.
Yeah, I know.
But it's what he wants. What does he want? What does he actually want?
The old Soviet Union. The influential, the sphere that the old Soviet Union had. His worst period in his life was the collapse of the USSR, and he wants to reconstruct it for his legacy. So Belarus, all of it. Anyway, makes me nervous. I'm hoping makes me nervous. And what's the dollar going to do? Where are people going to go? The dollar? I don't think they'll go to euro.
They seem to be going to the dollar at the moment. I mean, that seems to be one of the effects weighing on these pairs. Euro. That's looking a bit limp at the moment.
It's been limp since Thanksgiving.
Yeah, we've got that breakout.
So now all the shorts were gone with this happening, right?
Yeah.
So now where's the liquidity? The stops are here and here.
I think that 112, 111.70 level is the key level now. That's the 114 on the other side of this range. But I'm looking, the Fed could, if they confirm everything's going well and we do get a little dollar pop here, that might be the signal to start picking up euro dollar as what I've been talking about my trade for this year. Same as Stel. Might be the time to start dipping in, see what happens.
I think it's a silver in 2022.
I agree.
And you know what, Stel? And you know what? I still think there's a chance that, you have to feel like, I'm partially positioned, but if you had no gold right now with what's going on, and it almost seems too obvious to buy gold in front of a geopolitical event like this, doesn't it? The market's kind of railing into it. Still think there could be one more wash in gold and one more wash in silver, but I'm talking my book because I didn't buy the miners. But the miners, especially the silver shares, except yesterday, they look pretty good.
I agree. I think there is a chance of another wash lower, but the more time we spend here, I think the less probable it becomes. But like you said, who knows? The main thing is going to be the Fed today, like you guys correctly said. And theoretically, the Fed should not blink. They shouldn't change anything in their rhetoric. They should just take this opportunity that they've been given and go full speed ahead. and try to get as much as they can done before they have to reverse, which we all know they will eventually reverse. We did say yesterday and day before yesterday, Monday, we did say, Blake said this on this webinar, that look, it's most likely, or it's likely that we're going to get a relief rally into the Fed in terms of risk. And there we go, we've got it. And I think the S&P, if we get close to the 200-day moving average, which is around 44, 45, I think, something like that. If we get anywhere near that, I think that will be a really nice risk reward short. Obviously, it's a big risk
48.
to do something. Okay, yeah. It's a big risk to do something ahead of such a big event like the Fed, but all things being equal, I think they should. And I think they probably will stay on course and not change anything. Having said that, as I said yesterday, I think the risks are rising slowly for them to kind of appease the market, especially if they start dropping again. But, look at the S&P, it's 4,400, 4,420 something. We're only marginally below the highs. It's not, if you zoom out to 10% on a weekly chart, if you look at it, it's absolutely nothing. So theoretically, they shouldn't. Okay. But as I said before, if the markets start wobbling again and we get the S&P close to, say, 4,000, I think the chances are going to be rising fast for them to actually just put in a little dovish word. That's all they need to do, and let's see how it goes. But it is a binary, big event today. We have the Bank of Canada as well. I think the market's pricing something like 70%, 60-70% of chance of a hike. So, let's wait and see, and we'll react to the reaction, like you very correctly say.
Yeah. That could lead to a bit of disappointment move, because obviously if the majority of the expectations are looking for a hike from the BOC, if they don't deliver, we could get a knee-jerk jump in obviously dollar CAD.
Yeah,
and, maybe
I know guys looking for this. It's interesting. I remember numbers, and then I pull up like a weekly chart, and a major moving average is coming in here. I know guys looking for this before we get a big bounce. So this is still a huge drop in the S&Ps.
Well, you know what I'm looking for? I'll tell you what I'm looking for. I'm looking to give up Stelios's left
again.
It's an inside joke now, guys. It's a total inside joke. But
that Blake probably really enjoyed dissecting a frog in high school.
So, hey guys, happy FOMC day. I hope you guys are doing well. Do you really expect, Dale? And I'm just playing devil's advocate. Do you really expect us to trade down to those levels? I think what are you pointing out? Like 3,300. Who says that? Who says that the sky's falling? I'm just curious.
Good burn.
Good burn.
Peter.
Who's Peter Goodburn?
Elliott Wave.
Okay. All right.
Peter.
Right. Okay. Got it.
And he's not he's been bullish all the way, all the way up. He was early getting bearish here, but I'm just saying that he has a wave count like this, that it's going to be the biggest break since COVID, and that after that, and I'm not, if that number bothered you, I won't give you the final one, but there will be new highs in the market after this process of whatever the Fed is doing ends. New highs, actually new highs.
I know Ellioticians are, that's, they're, what they look for is, those longer, bigger cycles. I have a hard time figuring out what the hell is going to happen today.
And I know guys looking for 6,000 that this was a break to buy.
What's that?
I know a guy looking for a 6,000 that said there'd be a pullback, and then we're going from around here to 6,000 S&Ps in the first half.
Wow. Okay.
Well, that's what makes the market. Isn't it fun?
That's it. That's exactly right. And look, like I said, I have a hard time figuring out what the hell is going to happen today post FOMC, let alone what's going to happen for the next, 14
Yeah.
years, plotted out in the market. I will say that, looking at the S&P, I think that, if we can make it back just, around the 200-day moving average, maybe above the 200-day moving average today, I'm willing to give up Stelios's left foot.
Ear.
Yes, ear.
Yeah.
To sell some S&Ps. I'm actually looking for more of the 4,500 level. I think you still have to sell into rallies. Let's not forget the fact that the Fed and other central banks are reducing stimulus and just kind of draining liquidity, if you will, globally, and that's going to be more of a headwind than a tailwind, right? So let's just imagine that you want to sell rallies, and I think that at this stage, we're nearing the 38% retracement on the S&P, just after this move lower. The 50% retracement takes us back up to 45.25. So I think somewhere up here in this neighborhood, you've got to be looking to fade any type of rally, and today might be more of a relief rally when you walk away today post FOMC and you walk away saying, well, we already knew that, when the market goes, oh, well, we expect 3 or 4 rate hikes going into 2022, and the taper is going to go at this rate, and we're fine. That's exactly what the market was thinking. Then that's what's going to stage the rally. Now, if we walk away from today thinking, holy crap, maybe Goldman's right, and we are going to get way more than 4 rate hikes in 2022. That's when we start challenging these recent lows, and that's when you start seeing that 4250 level, really critical 4250 support that we talked about earlier this week. We're going to come right back into that level. So the good news is, and this is what I told everybody that's a ForexAnalytix subscriber, if you've been with us since Monday, and you've been listening to the webinars that we do just for the ForexAnalytix subscribers, I said, look, this is an FOMC week. So what we're going to do is we're going to find ourselves mid-range ahead of the FOMC. This is mid-range. You can see it right here. And we're a little, stronger than I had anticipated us by this moment in time. I thought we'd probably be closer to.
What lit it up? Microsoft earnings?
Yeah, I think Microsoft's up 2% today.
Yeah, that may have done it.
Something like that. I think Microsoft is higher, but look, there's, you're probably going to see some jostling ahead of the FOMC, but where I'm going to take my cues. And this is one of those situations where I tend to let, the smarter people like, the Ryans and the K-Mans of the world, try to, slice and dice every word that's coming out of the Fed and what Powell's saying. And that one of the great things about for example, I'll just, show you, this is the ForexAnalytix chat room, just so you guys can see it. This is the Forex flow room. This is what are we going to change it to? The macro flow room and Flowonomics. Sorry. Yeah. That the Flowonomics room. We're going to be changing that name. That's where you'll see the likes of all the guys macro dicing and slicing the market, and trying to figure out exactly what the Fed said previous and today, and comparing the statements and all that stuff. I'm just going to be watching price action, and I'm going to be watching gold. Really, gold's going to be my cue today. I'll go into greater detail when we do the Morning Edge webinar here in about 55 minutes from now for the ForexAnalytix.
I think Goldman just put out a buy in gold first time in a while.
That I'll be selling right into them. Just kidding.
Yeah, they just did it, I think.
I'm joking about that. But I know what the levels are that I'm going to be watching and why. So that's for me,
they're listening in on F.A.C.E right now.
Well, I'm not fast enough to read all the headlines that come through, whether it's Live Squawk or whoever you're using over here. When those headlines are coming out, I'm like, or if you're listening to Audio Squawk, which some people do, when you hear the headlines, it's like, okay, I'm actually going to just be watching price, and the market's going to dictate what we're going to be doing here. And I know exactly what currencies I am buying the dollar against if I need to be long dollars, and I know exactly what currencies I need to sell the dollar against. Should I be selling dollars today? And I think it's pretty, it's the setups are pretty clear. One thing that I will say is, we talked about the euro dollar 112.70 level being really important this week. The reason why on Monday or Tuesday we said that was so important, because you can see right here, this is the determination whether we start getting lower lows and lower lows and breaking back down into the trend. And I want to share with you guys that this this magenta trend line right here, this is a 2008
just needed to tag it again, bro. Right?
It's important. Yeah, I would say if we breach new lows and we get down to like 111, well, you can see 111.40 is the 161% extension of that last move higher that sucked a lot of buyers in. But anything below 112, you're going to be meeting head on with this longer term broken trend line. You can see it right there. This is a weekly chart, so
I think you have to attempt longs there, Blake.
I was going to say, if you are a dollar bull, you got to be a little bit careful at that point with the euro. But that's the euro isn't necessarily the trade that I want to take today. Although I do think that that's going to be the more boring trade today, but is probably the more likely. The more likely trade is the Fed's not going to alter their messaging. Powell's going to take this opportunity to really set the stage for raising rates going into 2022, the rest of the year, and really just kind of keeping the market with those expectations, which in my opinion is probably just going to be continued dollar bullish, which should push the euro down towards the 112 level. I think that's going to be the more boring trade, but the more likely trade. But I do know exactly what currencies I want to trade the dollar against, and if we sell dollars, I know exactly what ones I want to trade. So and that's important for you guys to figure out is find out exactly which ones you want to trade against. I think what the trickier one is going to be like the dollar CAD, as you guys pointed out, with the Bank of Canada today as well. And you've got, this rip higher in crude that's, nearing 87 again, which is nearing the recent trend highs. And you've got, obviously what's happening with Russia and the Ukraine, which throws another monkey wrench into the entire Canadian complex. This one's going to be a little trickier to trade, in my opinion. But we had traded the double bottom. If you were long earlier this week with me, I took profits in the dollar Canadian. Shy of 127. It was like 126.50. I actually got out of mine at this trend line. We overshot it because, the S&P was down like 150 points off the high. So we obviously got some overshoots in FX, alongside the currency market. But now we're back at the neckline. So this is kind of no man's land. You could flip a coin here and really, from a technical perspective, you could say, well, I'll be long if we break here. But if we break through here, we break through here, you're going to get stopped out. Or if you're going to get short, you just wait till, these lows are breached and then you get short. But like I said, I think there's no edge here. You can flip a coin and, your guess is probably going to be better than mine. So, I think waiting for the Bank of Canada is going to be the more important, decision there with the loonie. Anyway, I haven't heard from K-Man this morning. I was wondering maybe K-Man might have some final commentary.
He wrote to us he's not going to be on this webinar today.
Oh, okay. All right. Very good. Well, then we'll see him in the chat room. So Ryan, Stel, I don't know who else is here.
Steve is
here. Hey, Steve, any final comments before we pass it over to Dale? We got about 5 minutes just to kind of hash things out as equities continue to recover here. And I can prepare to give up Stelios's left Thumb.
It's so wonderful that we can all bet on Stelios's limbs and extremities,
Well,
right?
Believe me, I wasn't going to give up a limb last time we were up at 47.50 when I wanted to be short up there. So it wasn't a limb.
It was an extremity. You can say it like that.
That's right. Yeah. So Richard said he's running out of body parts. So what else? What else are you guys thinking here? I mean, let's talk. What's the Fed going to do here, and how are we going to make money? Hit me with your best shot.
I reiterated yesterday a couple of times what I think, which is that the Fed is not going to do an about turn so soon, in my opinion. So it is very likely that it's not going to give a hand of help to the market yet. I think that it eventually is going to happen, and I think it's going to be this year. But I don't think they've reached, given the fact that inflation remains extremely, extremely high, almost 4 times above their target that they've moved 1 billion times, but it's still almost 4 times above. So I think that the risks today is for a market disappointment. So more dollar strength and more
continued dollar weakness or continued equity market weakness.
Yeah. I think the risks are tilted towards that side.
Yeah, and I think a lot of people are thinking, the Fed, they're going to be so worried about this, 15% decline or 10% decline. But let's not forget that the markets are still holding up very well, and I mean overall, and yeah, the Nasdaq's succumbed a little bit to rates moving higher as of late, but you look at the Nasdaq and look, we are how far off the highs? I mean,
17%.
Well, we were 17%,
yeah,
19%. Yeah. Now we're only 14%. So look, we're not in bear market territory. We got plenty of time to go.
Oh,
but
yeah.
I mean, in all actuality, I mean, you're just seeing rotation. I mean, you got the Dow that's down a lot less than that percentage wise. So
all these meme traders that came in during the pandemic,
yeah,
they're all completely, but besides being wiped out if they held all that stuff, everyone is completely trained to buy every dip. And
it's not Pavlovian, right? Yeah. I mean, it's
not just them. It's everyone, even before those new retail traders and pandemic. So,
yeah, I mean, I don't think any generation of traders have ever seen this type of economic expansion for as many years as we've had, and predominantly due to central banks, but also this bullish move that we've seen for the last 12, 13 years straight. I mean, it's been crazy, minus a month and a half of a black swan event pandemic. But anyway, what are you thinking, Ryan? What are you thinking here? I mean, as far as what the Fed's going to do?
Well, the time for talking's over. They're either going to rein back on expectations that we've been speaking about, people calling for 8 hikes this year. Yeah. That may be seen as dovish. But, we've had the chat. Now it's time to walk the walk. Plan your levels, look at your ranges. If the market is going to make a move, if something is changing, then we're going to see level breaks. If we don't see level breaks, that gives you your trading clues and you know what to do. So get on your charts, find your bigger levels, find the ranges, see where the price has to do something to change the picture. And if it doesn't against those levels, you got to trade.
Speaking of, changing the levels, I mean, we got the dollar yen that continues to hold up above, 112.50, you guys know, is like, this is
it should have gotten killed Monday. It should have gotten killed Monday. Don't you think, Blake? With what?
Yeah. I mean, I would have thought so. But then again, yields are, the breakout in a 10-year and, I mean, 30 years holding up. It's hard to see the dollar yen, slip too much. But what do you guys make of the dollar yen here? I mean, is this the trade? I can't put my finger on it. I've had a hard time trying to nail down the dollar yen moves as of late. What are your thoughts?
Well, it's like a tortoise that's got into its shell, isn't it? You quite rightly say. We were all lining up at 12.50 last time we went down. Then we never got close enough.
Yeah, right here.
You know, it's doing its consolidation thing. You know, we've come through a January where the market chatter has turned very hawkish on the Fed, and it hasn't, and all it's done is fallen from the highs. So it's in no rush to go anywhere at the moment. I think yields are going to be the leader again. So, you know, that's the first thing to look at once you've digested the headlines. What are yields doing? From that, you look at what the yen's doing, what dollar yen's doing.
Maybe
but as I say, if we can't crack these levels, you know, I'll be looking at sort of, you know, we've got the old level at 114.50, 40.50. That's been a, you know, big long time level, you know, the huge level. You know, if we can't crack that, then you've got to think, well, the Fed's being a hawkish, they're staying on a path. Why aren't we going higher? Why is this pair not breaking higher? And you know, that's what you got to look at. You can listen to the price action.
Yeah, I know the price action, but maybe the whole issue right now is because people for once feel that the BOJ might actually become a little bit more hawkish. So maybe that's what's throwing everybody off with the dollar yen. Because, you know, I've been trading predominantly FX now since 2001. So that's when I, you know, really switched from trading equities full time to trading majority currencies in 2001. And I can't even remember a time that I remember even remotely thinking that the BOJ was going to be hawkish. So maybe that's what's throwing the market for a little bit of a loop here. Anyway, guys, I want to say that if you haven't tried out ForexAnalytix, make sure you do so, because because out of requests from our current client base, because of the subscription price that we offer a discount right at the beginning of the year, because we were supposed to end it last weekend, but we got a lot of requests to extend it through the end of the month for a lot of people from the way they get paid and whatnot, so they could re-up their annual subscriptions. We actually have moved that out to January 30th. So, you know, we do this pricing once we kind of get close another time in the year around the end of summer. So if you want these prices, you guys know you'll be waiting for a long time if you don't take advantage of them. So it's very good pricing that we do once, maybe twice a year. And so we'll see you guys on the flip side. Make sure you take advantage of it, and also download the mobile app when you guys take advantage of these prices. All right, guys. Dale, we're going to pass it over to you. Steve, Stelios, Ryan, good luck at the FOMC today. I'll see the rest of you guys.
Same to you, mate.
Yeah,
cheers, guys. 43 minutes from now,
Cheers,
we'll see you on the morning edge. Thanks, Dale.
All right. Thank you, Blake. Thank you, team. And you know, Adem, you should subscribe. You won't have to, huh?
I should subscribe.
No, Adem, my guest. Adem, welcome back. How are you? I solicit my guests for business. Adem, how are you? Waiting to hear you. Adem, you're unmuted.
Hi, Dale. You able to hear me?
Ah, I got you. Oh,
there we go.
I'm
doing good. How are you doing? I hope you guys had a good holiday.
Yeah, well, good holiday. You know, just watching football and COVID and troop buildups and markets broken.
Right? Yeah.
Yeah, my computer crashed when the market did, so
Oof.
I don't know what that means.
You're surviving, so can't do any better than that.
You know, I didn't clean
Dale,
up on the short
you should
side.
have known better. Don't confuse correlation with causation.
Yeah, I know. Well, I tell you what, I'll just pick up the phone next time and get my orders in. Thanks, Steve. So I'm really interested in them and what's on your radar. I know that last time you were on, you know, that you had some contrarian type positions that you were putting on. How are they working out? And are you going to share your screen here?
Yeah. Let's see. Are you able to see it?
Share screen. There we go. Okay, there you are.
Okay, great. Yeah.
Oh no. That's Al Pacino. Where are you? No, that's you. Al Pacino. Do you know who he is? Adem? Are you there? No.
Yeah, sorry. I'm trying to get the share screen going. Are you able to see my
I see your Twitter.
Oh, okay. Well, perfect. We got it going. All right.
It was a joke. That's Al Pacino, not a John.
Oh, sorry. I didn't hear you say that. That's,
you look like a rock star. So what are you looking at, buddy?
All right. Well, yeah, last we spoke, you and I think we're in agreement that we thought 2022, we were positioning for slower growth, Fed tightening, strong dollar.
Yeah.
I still think yields are going lower. I think there's a pendulum right now of between inflation and deflation. The worst of the inflation, I think we saw because of the supply side issues. I mean, we saw the government do an aggressive stimulus in 2020, creating artificial demand, and at a time when we saw supply sides getting wrecked because of COVID, and obviously that pushed prices higher. And 2021 was a year full of noise, but I think one of the most important things we saw in that year was the return of China's aggressive surpluses. And when China runs a current account surplus, that consequently, it means on the other end, someone's running a deficit. And since we're seeing the Eurozone and Germany run huge surpluses while running their own QE, I guess it looks like the US is stuck continuously funding those bond credit demands. And I think we're going to see investors continuously willingly fund the US because there is a huge savings glut, as you and I have talked about in the past. Since the 1980s, there's been the rich are getting richer. Obviously, we've seen a huge asset bubble, and the rich can't put their money under a mattress. Correct? I mean, everybody knows this at this point. As the rich get richer, as corporations get more cash flow, they have to put that money somewhere. It's not like an everyday person where they can stash it. Actually, there's a lot of studies that have shown that the savings glut of the top 5% has fueled the debt trap for the other bottom 95%, which makes sense. As the banks get more cash, more supply, the yields have continuously dropped. The interest rates have declined while they compete with each other to get that money out the door. Well, since this year, we've seen banks, as I pull up this chart, the overnight reverse repo. This is something I think a lot of market has completely forgotten. This has kind of been a soft tapering.
Thanks for reminding us.
Yeah, to me, it's amazing that this shows perfectly what's happened in 2020 and why we're not seeing any big growth or why any tightening by the Fed is going to be, in my opinion, nullified. The QE has been officially more or less nullified. This is each night. Banks and money market funds and basically the financial institution are having to park $1.6 trillion every single day in overnight repo to get collateral back from the glut of cash they have. So for those that don't know about QE, in summary, QE is when the Fed sucks high-yielding assets, meaning bonds, out of the system, which people want, financial institutions want. The wealthy consider bonds as money, but they're sucking it onto their balance sheet, and instead they're giving banks zero-yielding assets, known as cash, because cash doesn't yield anything on its own. The theory was, when QE began, let's get banks loaded up with reserves and deposits and cash, etc., all the same thing, basically, so that they'll lend out. But the thing is, banks only lend when the economy is healthy. It's not just the demand side. So for the past 40 years, supply of for the last 10 years, supply of money has not been the problem. So the Fed keeps pumping more money into the system, but they act like that's the problem. That's not the problem. Money has never been easier for the past 10 years. It's the demand for the money has eroded as leverage has increased, as marginal investment has decreased, as wages have decreased. And we've seen that over the last 40 years. And I think that the Fed right now, they're just pushing on string. And we're seeing banks kind of with the reverse repo. They're like, hey, like this chart shows, $1.6 trillion every single day the financial institution is sending back to the Fed in a soft tapering. It's almost like it's nullified the entire QE that's gone on the last year and a half. So in my
Okay.
opinion, that's already a soft taper.
So if this was already a soft taper, and now they're in a hard taper on top of it, right?
So now because of so now the Fed's in a box because like in the 1970s we saw the wage price. Sorry, everybody talk about like great inflation, occurring like the 70s, but it's a totally different dynamic. Unions were never stronger in the 1970s. They were fighting for the wage. It caused the wage price Keynesian cycle.
Right.
It showed how the Phillips curve was a complete mockery of economics and how it imploded with that. Like, oh, the lower unemployment means you're going to have higher inflation, which obviously in the 70s when unemployment spiked and then inflation spiked at the same time, it showed that correlation is ridiculous. Not to mention, the biggest part of the 1970s was the supply side with the Saudi Arabia oil embargoes. Exactly. And that was what really hurt people. But in this day and age, we've seen such a concentration. There has never, some research I did.
Ravi Batra wrote about it 30 years ago in 1990. The wealth disparity was going to lead to a depression in 1990. So the Fed has, Batra was early, but is that what you're saying is because of this wealth disparity?
Yes.
We're going to have problems.
There's actually a great book called Capitalizing on Crisis, and it's written by Greta, I believe.
By government.
Greta Krippner, and she basically, her thesis went under notice, but it's important because she talks about how the financialization. So after World War II, there was a boom, and the government, the Treasury, had made a lot of entitlement promises. But the thing is, you can't escape the law of diminishing returns. We're seeing it everywhere. Total factor productivity, TFP, is the most important growth metric everyone should be looking at. And China, since the 2000s, was the main source of TFP because they were going through their second industrial revolution after the Mao Zedong cultural revolution. They went through so when America started their second great revolution, which to put in simplicity for everyone, the second industrial revolution was basically the great rotation from rural economy to urban. And we saw that in China, rapid. So as America went through their rural to urban rotation, in about 120 years, China sped through theirs. Exactly, 20 to 30 years after Mao was out, and his successor, the one who kind of put China on its, at more capital. I mean, they can say they're communists, but they're more capitalist in spirit. But so that has fueled growth. The glut of money from the Western world that was looking for yield flowed into the emerging markets, and but sorry, before I get to do that, so in the 1960s to 70s, and so the Treasury had promised a certain amount of entitlements, but the problem is diminishing returns happened and growth started sinking, and that put the U.S. government in a pickle. Well, actually, all major economies in a pickle, because when you have growth declining, but your entitlements and like promises that the government made to their people increasing, how are you going to afford it? Well, Fed steps in. Hey, okay, if incomes aren't going to increase because of growth, let's cut interest rates so that debt can become cheaper so it can supplement the lost income. And that's effectively what we've seen since the 1980s. We've seen the hyper-financialization of the U.S. economy. And I really recommend Krippner's book showing how that economy has taken place, because if, for instance, to people who want to understand financial,
do you get that title, Professor Volge? I know you're auditing the class. Okay.
All right, great. It's a great book. It can be a dull read for most, but it's highily recommended. Most of this work can be dull because it's important. Oh, great. I'm glad someone else does too. But
you two are the only guys.
Right? I mean, it's dull, but it's very important because a lot of people, they assume just that, the Fed just started forcing rates lower to, because XYZ of Reagan or Volcker, whatever, but they don't look at the causal relation that the government was effectively broke almost at that point. I mean, they not in debt, but that they saw that the people and everybody incomes were diminishing. So when you have incomes diminishing, you have to make credit cheaper. It's like, okay, let's supplement those loss of wages. You know, if people are losing 5%, then they can use their credit card or et cetera. But the problem is, as leverage increases, demand for money erodes, and which is like, as we saw with Irving Fisher with debt deflation. And that's what we're seeing in the economy since the 1980s. There had been very low I call it deflation, Japan deflation, but some call it disinflation. But you saw one of the longest periods. The only other period was the late 1800s when the first gold standard started, with the longest period of sub 2% inflation. And the Fed has been trying tooth and nail to fight that, because in a debtor economy, inflation is what you need. You need to inflate the debt away, right? Otherwise, it becomes a burden, and it creates the debt deflation cycle, because if there's no more demand, then prices turn, and if housing prices or stock prices start turning the other way, and the wealth effect, which is effectively what the Fed has tried to do by creating an asset bubble, because they're like, hey, all right, if we can't make people wealthier and they're already credit cards are maxed out, let's pump their home values up, their home equity up. Let's pump their stock prices up so they can take that Caribbean cruise, or they can go on that extra trip, or they can buy that Xbox or XYZ, whatever they want, because of.
So has the paradigm shifted in your view, Adam?
Well, my opinion is the Fed is just pushing rope. I mean, there's
on a string. Well, they're trying to tighten. I mean, when they're easing and no response, to me, is what meant pushing on a string.
Exactly.
That means you're trying to stimulate, but it's having no impact. QE.
Exactly.
And QE was losing its impact anyway. But aren't they moving towards more restrictive monetary policy for a while until there's an accident?
So exactly like you say, until there's an accident. So the Fed is going to jawbone, but the thing is, the higher interest rates on the short end of the curve have already kind of done a lot of the work for the Fed. As the economy became more financialized, it meant more reactive. So back in the day, when Greenspan even said, he said, "Oh, we'd cut the Fed funds rate at the very low, very end of the curve, like the bank interchange rates, and then over time it would trickle into the long end of the curve." But in the late 90s, he was even shocked at how Fed rate cuts or hikes at the short end would more or less influence the long end of the curve immediately. And that's what we're seeing today. So by interest rates, short end of the curve, even the 10-year going up recently has kind of done a lot of the work for the Fed. So even if they hike today, what is it going to do? We've already seen interest rates increasing.
We've already gone from 50 bips to 180 in the 10-year.
Yeah, and that effectively in itself is a tightening. That's what I'm saying. A lot of people, same with the reverse repo. These are soft forms of tightening already. And so if the Fed, I've seen a lot of people push back, say, oh, this just means money markets and the banking institutions have 1.6 trillion in gas powder that they can spend. But that's the problem. If they weren't spending it in 2021 when the economy was booming, and now we're seeing that growth fade because of mean reversion, what do they expect in 2022? So my forecast, like you and I spoke last time, is 2022 is going to be a year of slower growth, probably lower rates on the longer end of the curve. We've seen that QE is deflationary in the long run because it sucks collateral out of the system. And for, like we were talking about earlier, banks want yield. The rich want yield. They can't put their money under a mattress. They need to find somewhere. Insurance companies, they need somewhere to turn that zero yielding asset. Even if there's 2% inflation, that cash to them is toxic. Well, China's running a surplus. The Eurozone are running surpluses. So we're seeing investors in those countries look elsewhere. To put that in perspective, Germany in 2020, I believe, ran the largest surplus in the world. Now China is doing it again. China's current account surpluses have been declining for years, but now they're back up, and it makes sense. They want growth. They want money, so they're trying to export their excess abroad. But when one country runs a current account surplus, that equivalently means somebody else is running a deficit. And America for the last 40 years has been kind of that absorbing barrier for the rest of the world to get growth. So China, so the Eurozone, for example, they're running QE, but the Eurozone runs a surplus in general because they adopted Germany's fiscal responsibility, more tighter approach after 2012.
Yeah, but Adem, that has started clearly fading away as an intention. I mean, in essence, removal. Yeah. Supposedly he quit for personal reasons of Weidmann, and the loosening of fiscal limits, I think, is showing that the Eurozone wants to move away from that approach, at least somewhat. I don't know if you agree.
I do agree with you. I mean, Germany is the main driver of that. The rest of the Eurozone doesn't want surpluses. Obviously, we saw Greece and Spain. They can't afford it. They have double-digit unemployment for the last 10 years. It's not in their best interest to have that kind of economy. So Germany is forcing it on them. So we'll have to see what that changes. But as theirs have declined, we've seen China's increase. China's current account surplus hit, I think, like the decade high in this last year. So they're trying to export their gluts abroad, and it's forcing America to absorb the debt. And the important thing, and like you said, Steve, the important thing is in the time as this is happening, investors in those countries. So if your country is running a surplus, you're not issuing debt, correct? Like America's the big debtor because they're constantly issuing debt, which creditors want. So Germany and the Eurozone aren't issuing new bonds as much as before because of these surpluses. At the same time, the European Central Bank, the ECB, is running their QE, which is sucking whatever few bonds are left out of the economy. That's why we've seen a huge rotation from like Belgium and European investors in the last few years rotate.
But Adem, if there's been this type of demand for the bonds, we've had a pretty big break in the bond market all the way down. And so, are you a believer that we should be looking for spots to buy the long end of the curve here in this environment?
Yeah. So in actually, as irony is, last year I thought bond yields topped out at 1.8 in April, I believe, and I, wrote to my investors and everything, just my blog.
Yeah, I'm just wondering how you're going to deploy assets in this environment that you're describing, and I'm not clear as to whether or not you think we're headed towards another deflationary period, or we've been in one, or if the Fed has a shot at taming, which I think, embedded inflation. I don't think soybeans or wheat or copper, maybe copper, but agricultural commodities don't care about higher interest rates.
You're absolutely right, and I think that's the problem with how skewed and bastardized the idea of inflation has gotten over the last 40 years. Because there's three types of inflation: you have demand side, supply side, and monetary side. Monetary side basically is gasoline on the other two and makes it more volatile. But demand and supply side are the most important. So if demand doubled overnight, you would see, and supply stayed stagnant, prices would double. If supply, like we saw in the oil embargoes, got cut 50%, you'd see prices double, more or less, right? So the thing is, so we've seen the supply issues happen, especially in the used car market and in the US. Exactly. And it's played, but in my opinion, this is temporary because higher prices lead to excess supply, and which we're going to see companies start pumping out. I mean, that's been the trend for 40 years. I mean, the globalization equivalently meant gluts. It meant, hey, any country can export their surplus abroad. Back in the day, you couldn't do that. How could you keep the meat before there was air-conditioned freighters?
But isn't the whole supply chain thing something that's going to take years to resolve? We have the just-in-time inventory to never-in-time inventory to having unreliable suppliers, as China tries to pull away as much as possible from the U.S. So how's that until we bring manufacturing back to the U.S.? That's going to be a long-term process, isn't it, to relieve the supply chain?
You're right. It could be. I'm actually, I was impressed with how resilient the supply chain has been, except for like the semiconductor market and the car market during the COVID period. I was really impressed with how, like, hey, even during a pandemic, the economy was able to adapt, and we didn't see higher inflation. I mean, I would go to my supermarket at the beginning, and there would be no toilet paper, and in free market ideology, especially in America, I think there's an oligopoly in the meat market. The top two firms control like 90% of the meat company. And that's a whole nother issue, is corporate concentration, which I hope we can talk about one day separately, is how, just there's been a total consolidation over the last 40 years, sprung between a very lax antitrust enforcement, meaning completely just mute. They're not even trying at this point to stop. I mean, we just saw the other day, Microsoft bought Activision Blizzard, one of the biggest gaming companies. That comes months after they bought Bethesda. So effectively, Microsoft now controls 30% of the intellectual property of the gaming industry. And I posted it on Twitter, and a lot of people were like, "Oh, but who cares? Those companies make crap games anyway." And I'm like, "But that's the point. When you have fewer companies, the quality declines, and we're seeing gaming prices go higher, and we're seeing that across 80% of the industries. The top four airplane companies control, almost 90% of the entire market. The top six banks control."
Speaking of which, do you think that this buyout is actually going to go through?
The antitrust department, I think the last time they even really did anything great was when Whole Foods tried to buy Wild Oats chain back in the early 2000s, and at first it went through, but then they kind of had Whole Foods divest Wild Oats, because they said they found out that they were going to raise prices. Well, every time a big merger like this happens, they raise prices. So I wouldn't be surprised if it goes through, because as we've seen, let me just find the chart of antitrust enforcement.
And before we wrap here, Adem, I'm interested in how you're deploying capital and what kind of bets you're making for 2022.
So 2022,
do you want to share that?
So I think 2022 is going to be a year of Fed policy error. Not that I don't think they should hike.
So rates. Are you buying long-term put options on rallies now in the market?
Yes, actually. So I had been, I actually got lucky in November. I wrote to subscribers that I was short Germany. I said, hey, I think the German economy has worse days ahead as the tide turns. And the thing I love about optionality is that it didn't even matter if I was right or wrong. Let's say I was totally wrong, but now with Russia, the whole Russia crisis with Ukraine spreading fear, or Fed tightening in Germany has caused their asset prices to plunge. And all of a sudden my put options are up 500%. So that's why I love optionality. I think it's so important. You can lock in something today. It's like insurance. It's like you lock in a position or a gamble, and something that I never even thought would happen, Ukraine, Germany, or whatever with Russia, causes a crisis.
Great call. Nice.
Yeah, and so I think so. Sorry for 2020.
So you stay with this. It's it continues to unfold.
Yes. Yeah.
There are rallies, but do you believe this is a shift from buy the dip to sell the rip?
So I think that as the Fed continues their hawkish momentum or stance, and the market has priced it in, as we talked about earlier, they already lifted interest rates basically for the Fed at this point. The thing is, I think the market, or a lot of investors, don't realize that there's lag effects. Markets are reflexive cycles. We'll see it. A boom will be self-fulfilling. It will carry itself higher. And conversely, once it starts turning from the top, it will pull itself lower. And we see these big volatile swings. And the more money is printed, it's like we said earlier, there's gasoline on top of it. So the booms get bigger and the busts get bigger. And as more we see...
Is there a chance for the dollar to shift into a bear market mode? I know you've been constructive for a while.
I don't think so, because like you and I have talked about in the past, for someone to sell, so effectively that means investors or whatever banks, institutions would effectively have to sell their currencies. No, I'm sorry, they would have to sell dollars to buy another currency. Well, what would they buy at this point? What would you want over the dollar? I mean, it controls 60% of SWIFT. Almost all payments are still in dollars. Bond market in America, investors are begging America to run deficits at this point to finance it because they want yield. I don't see how we would see the dollar really fall back to lows like we saw after 2008 when we saw the gold bubble pick up. And I'm a big fan of gold. I mean, 2016 to 18, I was
How about now?
lapping up gold. I mean, now it's a different ballgame. Back then it was 1,100, 1,200 an ounce. Now it's 18, almost 1,900 an ounce. And a lot of that has to do with inflation. But I think as we see emerging markets and other firms have to liquidate to pay their debt, unless somehow there's some big jubilee where debt is forgiven, that I don't know how they're going to finance it. We're going to see debt being dumped on the market, which we saw in third quarter 2021, if I remember right. We saw Turkey dump a lot of their gold on the market to raise cash. And
maybe Putin's going to have to sell some gold to fund his adventurism.
Yeah, no, you're totally right. So I wouldn't be surprised. Like, I like gold. And to me, gold is insurance, whereas gold mining companies and et cetera are, for wealth creation. It's like speculative, whereas one is,
right.
Hey, if the dollar goes to hell, I can take this gold ounce, go to Japan or whatever country, and I can convert it into XYZ, and it will never have a non-value.
Well, at that point, they're not going to let you leave, and they're going to take your coin.
You're totally right. At that point, I mean,
so anyway, I'm just saying, man. It's nice to be Walter Mitty and think that we could all just. You're
right. You're right. At that point, the government.
I think we're already locked in, man.
No, anyway, you're right.
You another great interview by an insightful and really passionate young economist. You are, and a better. Very good speculator. Next time you have those that kind of call, ping me and let me know what you're thinking.
And Steve, thanks for everybody Steve, for chiming in.
Thank you, mate.
Adem could be he could be your mentee, or maybe he could be your mentor.
I could learn a lot from Steve. I appreciate it.
Anyway, I'm just trying to put together a little bromance here.
Well, I appreciate it, and I respect the work you guys do and everything. And like you said, it's all subjective. We're all just sitting here trying to navigate the world. We get lucky, we don't get lucky, but the more knowledge we have, hopefully we can make better decisions. And et cetera.
Amen to wisdom.
Exactly.
So thank you for sharing yours today, Adem.
Yeah, thanks for having me, guys. I always appreciate it. It's always an honor.
I'll get you. We'll talk or exchange messages a little later and keep you going in the rotation. Okay.
Okay, sounds good, sir. Have a good day, guys. Thank you.
Again, you could join the team in 13 minutes on the Morning Edge. And guys, even Adem, you ought to subscribe to us for some of your trading timing. Maybe we could help you. I'll talk to you guys later. Everyone, take it easy. Don't just count your pips, count your blessings. Can you believe I almost forgot that today? Steve, can you believe that? I'm really off. I'm off center.
Good
okay.
Excuse.
All right. See you guys.
Bye-bye.
Bye.